Well, Mark, thank you very much for that kind introduction. The first panel today with distinguished guests is really to sort of evaluate and discuss how our standards have come to light. And I think one of the things which is unique to the FSMB, as Mark said, is the broad participation of the people that have been involved to try and reach a conduct standard that everybody can adhere to. So what I'd like to do is just ask people to introduce themselves, not just for their day jobs, but also for their role in the FSMB. And then I'll kick off a little bit about the issuance standard that was developed by the FSMB. Serge.
So my name's Serge Gwynn, partner at Oliver Wyman. I was working with the Fair and Effective Markets Review, supporting Elizabeth Corley and the Market Practitioners Group. And then subsequent to that, have been working on various of the standards, including commodities, binary options, information sharing, and various other components.
My name is Brad Crombie, Aberdeen Standard Investments. Aberdeen made a pretty significant contribution, we felt anyway, to the FEMR report. That led to our involvement on the FMSB pretty much from the get-go, and I'm currently on the advisory council.
Jonathan Brown from Barclays. I was involved in the new issue standard, the working group that was run by Rob Reedy to start with, using the experience from a syndicate bank position, and then latterly took over that working group as we move on to the second paper.
I'm Vandita Pant. I represent BHP in the board and in my personal capacity in the advisory council. BHP is one of the corporate members of FMSB, and using this as a yardstick for not just our own standards and the way we operate our treasury operations globally, but also of what we expect of our financial counterparties, including the banks.
Having spent some time in investment banks back in the sort of 80s and 90s, I mean, I've sat next to syndicate desks, I've watched them operate. So I've got a kind of picture about kind of what did happen then. And I'd like to know perhaps a little bit as I explore the panel about what happens now. One of the things that fascinates me about this particular standard is the ability to bring all aspects of the market together. Jonathan, can you just describe a little bit, how did you get the facts onto a piece of paper, and how did we get to where we are today to get the content and agree by so many different kinds of market participants?
So I think the first part of the discussion was around the table, and it was obviously a broad subject matter. It didn't, the new issue standard wasn't the objective from the starting point. So as we got issuers, investors, banks, and others around the working group table and talked about the credit markets generally, it was the new issue process that came out very quickly as an area where there's already very effective bodies involved, AFME, ICMA, Investor Association, but there was nothing that had included all three aspects of the process. And so I think that was very interesting from the starting position, that there's investors around the table that were involved in the activity pretty much every day, but perhaps weren't aware of how it worked from start to finish. And the same was true of issuers, some frequent, some less frequent.
And did you find that there were commonalities between the user groups about what particularly was of interest to them? Are there particular things in the standard that you ended up focusing on as an issue that needed to be resolved, or was it perhaps just a broader issue about how bonds come to market?
I think it was really closing the loops where the investors didn't quite understand why the process was as it were, and the issue was the same in terms of going through the chronology and finding common ground in terms of why is it that it's actually executed in the way it is today, who benefits from that, and then really looking through a transparency lens. Is that fair to all three counterparties involved in it? And so from that discussion and debate, heated debate sometimes, came commonality in terms of pushing back on certain points, but also accepting that for one side there needed to be a slight adjustment to what was in the procedure.
From an issuer's point of view, corporate bond spreads, narrowest they've been for many, many years, can't be that difficult to get the stock away.
No, it's not. But it's not about the difficulty, but it's about the transparency of the practices in the market. And to be having a transparent market means it's going to be fair in mandating the right people, banks, and it's fair to meet our objectives, which are explicitly talked about in the beginning, and it's fair and transparent to the investors on how the process comes to end. So just to add to what Jonathan was saying, I think from our issuer perspective is the issue of, are all handovers between right from the time when mandate is given to the post-launch of the deal, all the steps which happen, are they clear? What is the practice there? And what is interesting is the good practice is not defined anywhere. And that's where the interesting part is, that rules may be something, but is the practice consistent? Is it transparent? Do all the people, investors, banks, and issuers think of practice being the good practice the same way? And I think that's where this standard was interesting, because it does touch everything around all market participants.
And of course, the Treasury team does a lot more than just manage issuance. So I guess that your team is, their time is stretched and to do many different things. Does the standard help you in training in terms of allowing responsible staff that perhaps work for you to have a better understanding of what it is that you expect of them when they're delivering an outcome for the firm?
I think for sure. For my staff and for my staff to know what to expect of their counterparties being banks, for example.
So if somebody comes to you now and says a bank's done this, you have a way of responding to them in some respect. You have a framework to that response.
Absolutely. And the standards, some of the first principles on the standards mentioned, talk about that. How the mandate letters get framed, how the objectives get framed, how the allocation strategy part and preferences get framed are clear. And that's the expectation now. The beauty of being transparent is the expectation setting can happen between different financial participants. And it also makes it a level playing field, because everyone is playing by the same rules in terms of the practice in the market.
So if you choose one counterparty, one syndicate bank over another, you feel now you've got a little bit more sort of control over that process. You know not what to expect, as it were.
Yeah, the best practice is defined. I for sure, we have put it as our code of conduct and the work practice, that we will actually ask whether the member firm or the people who are bidding for our RFP are actually members of FMSB, and whether they have signed adherence statements. Because that by itself gives us a comfort of the good practice adherence, and that's the expectation.
Before I invite Brad in response to that, Jonathan, do you think that by creating that transparency, it's taken any edge away from your sales process? Now that you've almost become an equal amongst providers of syndicate, I mean, does it take any edge away in terms of who chooses you for what?
No, it doesn't take any edge. I think it's, as mentioned previously, it's not about executing the bond or selling the bond. It's about how you go about that. And I think actually it's given equivalency around the street. And that was one thing we were very mindful of. This shouldn't just be for the larger investors, for the most frequent issuers. It should be for everyone to look at. Even if you're a debut issuer, you get some guidance on where you're going. So I don't think it affects the competition. The competition is always fierce, but it just sends a roadmap in terms of the best practice around the execution of a new issue. And just one example of that, which is really interesting in terms of how you allocate the bonds at the end of the process. Every bank has a very clear compliance policy around how you allocate bonds to make sure that it's fair within a bank's position. What we found was, from the issuers, they weren't perhaps getting enough time at the beginning of that process to tell the banks, on this occasion we want the investors X, Y, and Z, or a certain geography to get the bonds. So we just added an extra step there so that the issuer, whose bonds they are, gets a chance to direct things before you get into the full execution. And it was small things like that. There wasn't anything concerning from a reputational risk perspective, but just adding that step.
The understanding.
It just helped a little bit more transparency, step back from the process, which can be very quick, so issuers can feel, if you like, emboldened, even if they aren't frequent issuers, to direct the banks in terms of how they want the transaction to proceed.
Brad, probably one of the biggest gilt portfolios, if not bond portfolios in Europe. I mean, do you think this process in any way has perhaps maybe, could I suggest, hindered you in the sense that now there is this standard, you are just one of the customers that comes to the market and not maybe a special customer?
Well, I think when we started this whole process, when we were getting involved with FEMR, actually our concern was one of fairness. And when we thought about fairness, what we really meant was, as you get smaller, as that tail of buyers of bonds gets smaller, how are they going to be treated versus the bigger guys? And at that time,
and you see the little guys as being relevant to the overall market structure.
Absolutely.
In that sense. Yeah.
Well, I think it's also because, a few years ago, Aberdeen was a
little guy.
Not little, but we were certainly on the smaller end. Certainly within the UK and European space now, we're much bigger. That doesn't mean we don't care about the fairness for that tail of the buyers. In fact, I think we still have the same belief strongly held. As to whether it helps or hinders us, it definitely helps us. I think, some specific areas I would say within the standards, I would say certainly the 15-minute kind of extension as the book is being built, about to be closed.
Talk us through that a little bit.
Yeah, so, when the idea is, when significant parts of the deal are going to change, well, first of all, it says, try not to do that right before the deadline. And if you do that, give your customers a little bit more time to reflect. I think that just gives the market participants who are buying the bonds that little bit more time to decide what they want to do. I think as a group, it gives a little bit better balance, actually, between the interest of the issuer and the interest of the market that wants to buy the bonds.
And when the selling terms do change, is that usually a relationship between you two guys? Is it the issuer and the syndicate bank that are saying, we need to make this change? Generally, what's the driver of that? Just put the 15-minute rule into significance in terms of the conversations that you guys are having.
Yeah, I think what we're trying to address there is that the number of the terms will be left until the last moment, and particularly at the moment when we do have good liquidity in the market, issue size can be changed at the end, pricing can be tightened right at the last moment. And that 15 minutes was introduced for the larger investors who might have multiple portfolios playing into that deal, so they can actually get that. It's purely just to transmit that information into the different portfolio managers, but also for the smaller investors, so they got a chance to reflect on the new terms and not just go with the momentum of a transaction that's looking successful by default.
So that time is giving people an opportunity. And how do you think that's being rolled out in practice, though? Are you seeing any evidence about behavioural changes from your side about how people are engaging you? And
well, I would say certainly the 15-minute side. That's pretty much everybody we talk to internally, and other people that I talk to. That's pretty much seen as everyone does it now. Mm-hmm. I don't think that was the case a year ago. I don't remember that being the case certainly a year ago. So I think that's a definite plus. I would still say that in terms of the talk of the size of the book and then how it closes and how that's disseminated, there's probably still a little bit more work that needs to be done around there. Because I think there's still, there are differing ways of dealing with that, which I think are probably worth looking into. Going back to the issuer side of things, actually I think some of the biggest beneficiaries have been the issuers for the good of the market, because I think the issuers it's been made clearer to them exactly how this process works. This is how we do things at this syndicate. And it also gives you a chance to say whether or not you'd like to amend that and say, well, I know that's how you normally do it, but we'd like to do it this way. Can we proceed that way? And I think a lot of issuers, going back, either didn't know that, or if they did, they would tend to pass that on to the syndicate desk's sort of discretion.
To deal with it, yeah.
Yeah. Not the only areas where I think it benefits, the market, but I think those are important ones.
For sure. And I think, again, the size and the complexity and sophistication of different corporates can vary around allocation objectives and how much of pre-mandate or at the time of mandate these things have been already discussed. And as a deal progresses, but I think the beauty of standards is that treasuries which may be smaller, who may not have the view and visibility around the whole process and how it links to their decision making, now have the tools and ability to do so, because it's very transparent on that this is a good practice, so use it and have that discussion, reflection on what needs to happen.
And in terms of the broadness of the bonds that you're issuing, are they always in sterling or using other currencies? And is this affecting the issuance of bonds in more than one currency, I think is the question.
No, we have always been a multi-jurisdiction, multi-currency issuer, so it doesn't change it from the perspective of which currency you use, which is a very economic, yield-driven issue. Again, also diversification issue. But I think it does enable the banks, which are all based here in London, and if these are the good practice standards to adhere to, then I would not say that I will expect it only for sterling bonds and not for US dollar bonds. So that's the part, and that's the expectation, for sure.
Coming back to the process, I said a bit, we have this concept of the advisory board and the standards, the actual board itself and the advisory council. You're sitting on the advisory council. When this paper was presented to you, can you just tell us a little bit about how you viewed this paper and in what sort of what kind of remit that you felt that you had once the paper arrived at the advisory council?
Well, I think first impression was, thank goodness. I mean, it's kind of overdue. I mean, that was one of the biggest issues we had when we contributed to FEMR. This was one of the biggest issues for us. Was this has got to be dealt with. And I think even in the earlier days, I would say, the consensus was not maybe as clear as it became, at the FMSB as to what exactly needed to be done. So for me, the most important thing was, all right, we finally have something that we can work with here, which is going to have some impact on the market and for the good. I guess, what did I learn from that? Well, I didn't think there would be probably 10 standards that you could write into that process. But of course, when you walk through it from start to finish, you're like, didn't think about that. That's a good point. We should be looking at that. And so while there are 10 standards across the board for that one area, I think they're sensible, they're moderate, and I think they make sense for the market.
I think we see the standards that we've written as effectively being living standards, and I think we have to acknowledge that things do change, and sometimes the financial markets quite rapidly. I suppose one observation to tight yield spreads and low interest rates is, does anybody have an opinion that if rates did increase and yield spreads blow out on corporates, would it make any difference to the practices that we've written into the standard? Or do we think that there would be a continuity of what we put in there? I mean, does a higher yield market, perhaps a more volatile market, change what we've written?
I think given Jonathan's point around market liquidity issue and how that gets into the execution process anyway as a consideration, keeping that aside, I don't see how any of the standard codes that we have referred to here need to change, because they are execution focused, they are best practice focused. It's not around the spread or the yield issue really. So I don't see that. Having said that, the markets do evolve, and market structures evolve. The market participants' roles evolve. So that's something to just keep an eye on and see if that needs to be refreshed. But I would not think that because the spreads change a bit, these practices need to change. Yeah.
No, and I think we were conscious of the fact that we were in a very positive market, and we have been for a number of years, and thought about exactly that question as we went through it. And it's a dynamic. It's a dynamic
sorry
document.
to interrupt, but maybe you've seen practice change slightly because it was a tight market, and over a period of maybe the last 3 or 4 years, in the scope of your bigger career, maybe you did see practice change a little bit because the spreads were tight, because volatility was low, for example.
I think there's a question of paying attention to all of the investors to make sure that, when conditions are good, do you need the tail of that order book? You probably don't need it to get done, but in other markets, more challenging markets, you do. And so you're writing this for every investor, even though you might clear a deal with the top 10 or top 15. The other point is it's a dynamic document. So as we're talking about the allocations and giving an issuer the chance to talk about allocations, if we have a riskier market where they want to be in and out very quickly, they can very easily just tell the lead banks, I want to get the deal done quickly at the best price, and I'm not too worried about spending time on allocating to investors. It's more about de-risking the transaction and perhaps more of a quality issue around where the bonds go. So I think it should stand up to more challenging markets.
Changes.
But it's going to evolve in many different ways.
Great.
Well, there certainly will be a time when the scarcity of new deals, when the kind of bonds that you want to buy in the market are going to be probably more available for the buy side than they are now. So I think the market just generally would have to adjust to that anyway. I actually think there was a case for maybe saying how those bonds get priced in a different environment where there are more bonds than maybe there are buyers. Pricing will probably stay more stable, actually. You're probably less likely that you get a bit of a pendulum swing in terms of how something would price, versus swaps or versus asset swaps. It should be a little bit more efficient, but don't want to read too much into it.
Closing on this particular standard and bringing Serge into the conversation, some of the standards that we've been working on have perhaps had direct read across in other markets. We've sort of incubated them in one area, and the binary options, commodity binary options standard was one example of that, where we worked at the Commodities Working Group to try and get a standard that was particularly relevant. It came out of concerns from the FEMR review. And we dealt with specific issues to do with reference pricing, conflicts of interest and stuff. Perhaps you can just talk us a little bit about your experiences of working on that standard, and talk about what you think we achieved in bringing that standard to life.
Sure. So it's, as you say, it was quite a narrow technical area, so digital options in the commodities market. One of the reasons for selecting that area was the concentration and the particularly high conduct risk associated with it, because depending on how prices evolve, there can be either zero or a very large payout, and so clear benefits for one side or the other. And there was even discussion of banning that structure as a whole. So I think one of the things that we wanted to do was to take it on, apply more clarity as to what is or is not appropriate, so that conduct risk can be managed. I think one of the tricky points around that is that on the one hand you can have appropriate risk management behavior and transactions to manage the risk profile that can have an impact on the reference price, which then could impact whether the option is triggered or not triggered. And there's a real difficulty there because it's difficult to unpick that behavior from inappropriate behavior that is directly intended to impact the reference rate.
And from memory, I think one of the things that we debated around the working group and concluded on was to try and get responsibility into the individual for their intent. We found it almost difficult, impossible to differentiate between the outcomes, but in terms of putting someone accountable for their intent about why they did something, we found that was the more effective way of describing the issue within the paper.
Yeah, that's right. So we had lots of discussion in the working group around, can we define parameters to say that, okay, if hedging is within this scope, it's okay, and if it's outside of that, it's not. And because there are so many different situations, it was very difficult to do that. And so, as you say, it did come down to trying to define kind of intent and to be very clear that if the intent is focused on risk management, but not hitting the reference price, then that's permissible. But if your intent is to directly impact the reference price, it's not. And I think that has flown through, fed through into market practice. So if I think back to discussions with various market practitioners a couple of years ago, in several cases, defending the option was defended as that is appropriate risk management.
What you do, yeah.
I think in the standard, one thing that has helped with, it's made it very clear that that is not.
No, I agree. And I think the other thing about that particular standard was that there was a specific read across into foreign exchange markets and also into fixed income. But we were debating how we put this binary option standard together, and we concentrated particularly on the commodities piece. But we did realise that many of the practices that we evolved in the standard did actually account for other parts of the FICC market. In fact, the development of binary options within FX is probably larger than it is in commodities, to be honest. But
yeah, I think there's a trade-off in the development. I mean, where you have similar structures across different asset classes, clearly it would be good to have consistency across all of that. But then there's a risk that it slows it down, and it takes a long time to get out there. So we tried to strike the middle ground, focus on a specific asset class, but engage with the other asset class working groups to make sure it would be consistent, and then the scope for rolling it out more broadly later on.
But one of the things you touched on, which I think shouldn't be missed in that particular standard, was if you will, the exposure exactly what a binary option was. I mean, I think we were going through when the market creates new products. I think it takes a bit of time for those that oversee, whether it's the legal structures, whether it's the regulators, to actually really understand what's going on with that new product. And I think this was an excellent example of bringing practitioners to the forefront of the discussion and developing a paper which basically demystified the practice. And one of the things I found personally quite satisfying about presenting this paper to the advisory group was almost this sense of relief that we had something that was tangible, and that, for example, if a lawyer was brought into some sort of litigation, he could pick it up and know exactly what it is that he was dealing with. And I found that personally satisfying, that we could actually give some sort of legitimacy to a process which was causing concern.
Yeah, I think, the start of any of these standards needs to be a description of what is the situation, what is the practice, why is it used, what are the conduct risks associated with that, and then what are the standards that can be put in place to mitigate those risks.
Now, in terms of cutting across markets, there is some work that's going on at the moment, which is development of either guidance or a standard on sharing of information around we call it confidentiality of information, but it was specifically designed to talk about how can you communicate between yourself, your client, and your colleagues around the order flow. And personally, it's been a bit of a labour of love because, like the binary options paper, it started with the commodities group, but this time, I think from our experience of the read across, we've allowed it to go into the other working groups as well. So I just wonder if anybody's got any views about where they think this paper's relevant and how important or not it might be in terms of finalisation of that piece of work.
I think it's an interesting one because it's a complex area. If you start from rules and regulation perspective, information sharing, confidentiality as a thematic cuts across all asset classes, all market participants' interests. There's no conflict of interest, really speaking, unless there is bad intentions involved on why what should be made available is available, and people are very clear on what is. Practice is not very easy to pin down, however. What is confidential? When do you share it? How do you share it? With whom? What is confidential or not? And I think the developing confidential and information sharing standard, which is being looked at, is important one because it does, if we are able to give very specific practice and examples, live examples on how to do this, how to read this, gives quite a good wrapper, and which is not related to a particular issue.
Because I think I might be right in saying that you made a comment at one of the board meetings about that you were finding it increasingly difficult to get sell-side firms to give you information on what was actually going on in the market because they were almost being brought to account into some sort of form of conduct anxiety. They were frightened to say something for the fear of the repercussions within their own firm. And for someone like yourself, who has a broad team doing many treasury functions, you can't be watching the markets, every blip, every movement. Surely that is the job of the sell-side firm.
Sure, and I think it's important to define practice so that you can share. The whole point of having banks as our counterparties who are watching the screen all the time is to be able to get the information that is available. However, if that becomes a weakness so that there is no information sharing happening, we don't even get what is there in the market, and someone needs to be dedicated 24 hours to look at it. So I think in that sense, the standard is helpful and cuts across asset classes. However, the other one, which is also a similar standard that we are looking at, is for a specific case when we have new bond issuance. What and when do you share allocation across desks, for example? It's a very specific case, and hence that's been picked up as a separate standard which is being worked on. So when the new issuance is done, the primary desk knows about it. What's the right time, granularity, when it gets shared with a secondary trading desk, for example? That's a specific kind of situation where the practices probably either differ or may not be consistent or may not just be transparent. It needs to be just transparent. Maybe they are consistent. And that's another piece of work which is carrying on, which again takes us to the next level after doing the new issuance standard of knowing all the handovers to say, okay, once you've done this, who has the information? When does it get passed on to another desk? Why does it need to? And what are the implications?
I think it also goes to how do you give market colour? I mean, I think it may be in the new issuance space, for example, about how a salesman might pitch the flows that he sees. I mean, certainly we would see it in the metals world about, what can you say? If you say there's a big Chinese buyer, is that an abusive statement? Or is it relevant because there literally is one? I mean, where is that line? Where is that cross? I mean, I think you've had some experience in the new issuance market about sales guys pitching to you, Brad, and you kind of, in your own mind, you're seeing the market change and you're sort of questioning about what's relevant and what's not, what they should and shouldn't say.
Yeah, look, as I mentioned earlier, I still think that's an area where further work is needed. By the way, to Vandita's point before, I can certainly tell you from my time on the sell side that there was always a discussion about when the New Deal went to the traders, and it wasn't always a nice discussion either. So it's the discussions are definitely going on. The question really is, was that formalized consistently every time. And I think, if you go back 10 years.
And from shop to shop.
And from shop to shop, which I'm
which
less
is
clear on,
also-
obviously. But, those are questions that I think some of the standards need to answer.
Yeah.
Because consistency is really the most important thing, as well as the transparency. Now, as far as the book size and how people talk about the book and who is in the book and not, the buy side's view, I think, is just be consistent. In some areas, it's actually not talked about very much. They just talk about how the book is doing. Actually, the time process, for example, that it takes in high yield to go from start to finish is just so much longer that by the time you get to the end of that process, everyone's been around it. They've looked at the credit, upwards, upside, downside, and sideways. They pretty much know what they want. In investment grade world, there's just so much more that's happening, and it's happening much, much faster. That's where I think, for example, the 15-minute thing I was talking about before makes a difference. But as long as there's a consistent approach as to how you describe the book, sort of start, middle, finish, the buy side, will live with that.
I think just to finish the point,
please.
The piece of what we're looking at on the allocations is really interesting because it's not around whether that's private or public. It's public information, but is from a fair and transparent process, is it fair that the lead banks get that information disseminated quicker than the rest of the market?
And where are you on that?
In process.
In process.
And there are different views from different banks, as there should be, and we're not trying to get everyone into the same spot. But it's just a very interesting one. The public-private is very clear.
Yeah.
The book dissemination is very clear. That has to be agreed with syndicate banks, and there's a clear process, and there's a clear breach around that. This one I think is more nuanced. Is it fair to people outside of the syndicate group or not?
And
that's,
I would suggest, sorry to interrupt, but is that partly to do with the kind of anticipated thought on hedging? I mean, is there some concern? I mean, what's the argument for one person having the information or slightly have the other?
It's not around the hedging, it's around the responsibility of the lead banks to provide liquidity in the secondary market.
Right.
Which is, for some issuers, is very important, for other issuers is less important, and it is a process that's been around for a long time and needs to be looked at.
And for this issue, is it more important or less important?
I would say that the intensity of debate and discussion on this standard and different viewpoints within banks, and then with issuers, not versus banks, but let's say different perspectives, is exactly why FMSB in its today's shape is so critical, because the market participants are not a subset of market participants when they are defining standards. There are people who are investors, there are people who are issuers, and there are people who are representing banks. And the market practice needs to evolve with this kind of a discussion so that everybody's viewpoint, perspective is taken into account, and the practice which emerges has had that sort of a sanity check, if you will, from each perspective. And I think that's really critical.
A question that's just come in, which is relevant to that, is that in that balancing, in that discussion, how is it that we're getting the balance between providing the granular and detailed descriptions and the more principle-based kind of concept that we've built in? I mean, I guess that the question is based on this definiting factor that some regulation and rules are prescriptive and others are more about principles. I mean, how do you think, as an FSMB, we've dealt with that balance? I mean, I think there is a balance. Personally, I think there's a balance, but I just wonder. Yeah, please do, Serge.
So I think it's evolving. So if I go back to the commodities ones, we didn't have case studies in there. I think it would be helpful, so I think that's a potential future development. In the information standard that's being put together, there are many more case studies to bring it to life, to say, in this situation, this is appropriate, this is not appropriate. So I think there's a lot of value to having case studies to make it clearer to people. I think they're hard to do, so it's an investment of time and people on the working group to put those together.
I think the other point there is, as we've talked about, it's dynamic and it's evolving, is there are also live case studies coming through. So we're starting to get inquiries about real life situations and how do we reflect on that against the principles. And I think that will be useful to then
The involvement.
let that evolve and socialise those more broadly as they come through.
And I think principle-based regulation or rule-based sort of cut it at different levels in a way. But standards is still I think, complementary to both of those, because standards basically says, how do I do this deal? How do I transact? Which sets what goods look like in real world when you're doing the practice. And that's I think, what is the complementary nature of standards, if you get it right. And because market participants, and hopefully in every standards, differing market participants input into it, be it the syndicate, be it the infrastructure providers, issuers, or investors, you get a standard which is a practice which makes the financial markets or FICC markets overall more transparent, consistent, fair, and hence effective.
Before we finish on the information and confidentiality, Serge, you've been a bit of a witness to some of the experiences of bringing this paper into from childbirth to existence. What's your observations about how we've gone about it? And as someone that's chaired that piece of work, what's your advice to me to perhaps do it better next time?
Well, certainly lively discussions, which have been good. I think that the starting point was that there was a concern that the pendulum had swung too far to conservatism, and that people were too scared to communicate, and that was impacting market effectiveness. I think the paper itself is trying to right the pendulum, possibly position it slightly to the kind of more aggressive end, recognizing that it's likely,
So
end
I was
up
too
somewhere in the
aggressive,
middle.
is what you're saying?
No, I think if you're too conservative, then it won't be impactful. So I think you need to kind of test the boundaries. In some cases, those boundaries will be right. In some cases, it'll need to be reined in again. But I think that was the right way to go. But it's a long process, because you have different views across the different market practitioners, and just between firms, different similar firms, they will have different views. So it's very iterative, and just takes time to get something that people are happy with.
We have 4 minutes before we finish, so I'd just like to maybe spend 2 of those minutes doing a bit more on the allocated book information. If there's just an update on that and where you are in the process of bringing it to some sort of conclusion, be very interested to hear on the progress. And then I'll finish and maybe just talk a bit about gold and silver fixings.
Maybe Jonathan, you want to start off, and then I'll...
It's a broader takeaway as well, which is the working groups and the organisation benefits from the diversity of the panellists and the exchange of views. And I think one thing we continuously need to do is add participants and have a broad range of participants, not just banks, but a broad range of issuers and investors. And I think at the moment on the allocation standard, we've had a lot of good work in terms of fact-finding on how it's executed across the street at the moment. We need more opinion from issuers and investors on what they'd like to see before we can take it forward. So I think at the moment it's just slightly too narrow to take forward into a debate. We need more people around that table to...
I think it's a good
thresh
point,
it out.
actually. I think one of the things I've noticed is that as the topics change, the need for a more diverse or different participation also changes. Yeah. I think leading into the work we're trying to do with the gold and silver fixing, and it was one of the discussions I had with the Secretariat only last week, was that for it to be successful and for us to come to any form of conclusion, we need to drag certain market participants with us that perhaps are not as broadly represented with the FSMB as they need to be. And I think it's something that Mark Yallop realised when we started looking at the algorithms and how do we get that right knowledge into the FSMB to get a successful and successful conclusion to the work we want to do. But I think it's an extremely good point that Jonathan makes.
Yeah, and I think the diversity of perspective is critical, because it shows, in this standard, it shows that from issuer perspective, what we don't know or what seems like opaque, may not be opaque, but it's not transparent to us, is something which we require clarity on perhaps, and make it as a good practice. And from shop's perspective, it may be absolutely clear, but then once we started to collate information, which was another interesting process, because there are ways or restrictions on sharing practice across banks. So issuers in the working group enable that to happen, so that it wasn't into the competition kind of other regulations getting stuck on that. But having got that, the very fact that different banks treat it differently or can articulate what's happening very, very differently just shows the point that a consistent practice needs to emerge, whatever that might be. Intensity of debate will, I think, carry on for a bit, though.
That's great.
If I could add something,
Please.
for your previous point on the feedback for the subcommittees. I think the fact that the rate of the standards that are getting done is picking up, the speed's picking up, I think shows you that people are getting used to how it works and the machine's working better. I think one of the first things I noticed at the beginning was that when members of the financial services community get brought into a room and are asked to do things, I think the first reaction is kind of like, I'm being told what to do. Yeah. And then when you realize that actually, no, you're here because you and your peers are going to set the standard for this. You're going to be the ones writing it. You're not being told what to do by the regulator. You're writing it. Then I think people's minds open up and they become less defensive. And I think if you look at the rate at which the standards are being done now, it's definitely picking up.
I'm going to finish this panel effectively where the FSMB started, which was, I remember my first board meeting when everybody did arrive from various firms and sat round the table. And I think it's fair to say that it's more organised now than it was then. So I'm glad that your observations show testimonies to that. Now, my primary job effectively was to finish at 2 o'clock. It is 2 o'clock. So I'd like to thank Vandita for your contribution. Gentlemen, thank you for yours. It's been a great experience. Thank you very much.
Thank you.